Let me start by something that may surprise you. Most investors underperform or lose money in the market. So I'm talking about 90% of even professional fund managers tend to lag behind the S&P 500, which is a broad basket of about 500 companies that are publicly listed in the US. And in this video, I'm going to share with you why in this case people lose money instead of making money, and what I do to actually beat the S&P 500. And what I've been observing in the market is that the most important thing is to learn from your mistakes. So make sure you subscribe and watch this video until the end. Let's start with the basics. I'm going to share with you why stock picking for most people is the one thing that leads to them losing money, how fees can quietly eat on the return for most people, and why psychology matters, as well as why simple strategies like using options strategies such as cash secured puts can actually help. In my case, it has helped me to manage risk and stay profitable, whether I am doing my trades or I'm investing for the long term. Now, something that I've been transparent about on my channel, what I'm sharing here are the things that I learned. So make sure you only take what is relevant to you. And remember, I'm not a licensed financial advisor. I'm sharing my own experience. Number one thing that I would say that from my conversations with clients that I coach is, number one thing that causes people to lose money: they just jump into business that they don't understand. For me, the first rule is that I want to invest in businesses that I understand. When I'm talking about businesses that I understand, these are publicly listed companies. For example, I use products and I see that, oh, this stock is actually publicly listed. That means I can actually buy the shares on the public market. So what I do is then I start to research and understand what this business does, and then see if it meets the criteria that I look at. So most people, what they do, they see it on the social media, whether on Facebook, on X, and whether a friend mentions it and probably jump in. I don't do that. I like to invest in stocks that I understand. That way, even if the stock drops, I have the confidence that, okay, I understand their financials are stable, they have all the things that I consider to be something that I like to see in a business. So I'm not gonna panic sell. I actually even possibly buy more when most people are panicking. Point number two is that stock picking is actually way harder than most people think. If you look at people like Warren Buffett, I was looking at his performance. If you look at it, whether from 1960 to when he retired in December 2025, most of his money he made it from very few stocks. Let's say if you look at the whole portfolio for Berkshire Hathaway, most of their returns came from companies such as Apple, which he actually admittedly got into later. He didn't get it when it just listed, what we call initial public offering. That is when it started trading on a public market. If you look at Coca-Cola, MasterCard, those stocks, they got in and they actually held it for a long time and money was compounding. But on the other hand, on most of the stocks, he actually lost money. If you look at some of the worst trades that worst investment that he did, he actually sold, right? And he admitted, for example, at some point, he got into airlines like American Airlines, and he sold for a loss during the COVID pandemic. So that's the thing. Most people, they think they are smarter than everyone else, and in the process, they end up, maybe if you have 10 stocks that you actually invest in, you have 5 that you probably get an average of 5%, and most of them, let's say you are losing 30% on average, your return in that case will likely be negative. So that's how most people lose money from my experience with clients that I coach and even reading online. A simple solution to that, and this is not investment advice by the way, is to just buy what we call the index funds. You can access them through what we call exchange traded funds. There are a lot of funds that actually have exchange traded funds. That is funds that essentially mimic in terms of the proportion of the stocks that are in the index. For example, if you look at SPY, for example, it's a ticker name for that exchange traded fund that is managed by a hedge fund that is actually in New York. And what they do is they just say if the S&P 500, the original index, it has, let's say, Apple 6%, they just do that. The only difference in that, you have to pay a smaller fee, which is relatively better than what people pay for mutual funds. Now, another silent killer is a lot of people, they just do mutual funds and get into investing using brokerage funds that have a lot of fees. For example, at some point I was talking to my friend, he was telling me that they actually had to take out their money. They made 4% last year. The S&P 500 returned about 17.9%. So imagine 4% before fees. So let's say they get charged 2%, their return goes to 2%. So in that case, it's just better to just do the S&P 500. It's not for everyone, but the point is, I don't want to be paying a lot of fees for something that is not even beating the market. That is the S&P 500. So that is something that is very interesting. So I have learned my ways. I did all these mistakes. I made these mistakes. So that's why I'm sharing with you guys, so that you don't fall for these same mistakes that drained my money in the past years. Number 3, I like to have an emergency fund. I have said this, and sometimes people just don't get it. I talk to some of my friends and they say, you know what? Especially, I was talking to a friend who is actually in an African country, and no stereotype, but I'm just giving an example. It's like, I don't need an emergency fund here because I'm kind of trying to make ends meet. So I'm like, one thing that I noticed is that I had to cut off on some things that I was just wasting money on, and I saved that money in fact. So the first thing that I do when I'm investing is I want to have an emergency fund that is at least 6 to 12 months worth of living expenses, so much that if I lose my income stream or something happens, then that means at least you have 6 to 12 months runway of actually maybe looking for another job or maybe finding an alternative source of income. In Canada and other developed countries, there's unemployment insurance. You can get up to 9 months, but at least you get something. But whilst you are doing that, you don't want to be forced to then go and borrow high interest loans. Here there are payday loans. I know in Zimbabwe, where I was born, there are these microfinance and they charge very high interest. So once I have an emergency fund, it means even if the stock market, most of the stocks or the entire market drops, mostly if I'm looking at the equities market, I can actually be buying when most people are panicking. And by the time other people want to get back into the part to start buying stocks, it means I am in the profit zone. I can either hold or sell and take the profit. That's a simple thing. I want to be buying low and selling high, and be patient without the pressure of selling at the bottom just because I want money to pay for rent or other basic things. Another important point is psychology. I just want to buy low and sell low, or sell high and buy low. That's what I do when I'm doing cash secured put. So a lot of people, they don't understand the psychology of investing. One thing is they are chasing stocks that are trending, and at the end of the day they don't even look at valuation. I like to do the opposite. I want to be patient, disciplined, and control my emotions, right? But as humans, from what I have read in psychology, we are wired for reaction, not for patience. So that's a simple system that I use. I just control my emotions, right? Now, I do things differently by following the following framework. I've shared this on this platform, and by the way, if you have watched this video thus far, please make sure you subscribe and support my work here. Share with me what strategy that you use when you are investing and what you have been learning in the markets in the game of building wealth. Now, in my own investing, I like to keep things simple. First, I want to invest only in businesses that I understand, and I don't want to chase prices. I want to wait for stocks to come to my buy price. And third, I use option strategies such as cash secured puts to buy them when they are low. So in other words, I sell a cash secured put. That means I open my position by selling a put option on that position for a strike price that even lower, especially after it has dropped and after I've done research. And then if I'm assigned, I take the shares and I would have been paid for that matter. So that's how I like to buy stocks. But of course, the disadvantage is you have to have the amount. Let's say, for example, I did a trade today on a stock called Celestica. I took a strike price of 260 and it was around 292, and in so doing I get maybe 1,300 premium when I open the position. But if it drops to 260, I get assigned. But the good thing is, if I want to buy it and if it will have dropped, then that's okay, rather than just buying at the current price. So that's the strategy. In that case, that means I had to have 26,000 to secure those 100 shares, because one option contract is 100 units. So that's what I do. That's the simple framework that I use. For me, the goal is to manage risk and to be consistent. So most investors underperform the S&P 500, not because they lack intelligence, but because they overtrade, they pay a lot of fees, they ignore psychology and invest without a plan. So these simple, boring and disciplined investing strategies helped me build the S&P 500. So if you want to learn more about this, make sure you book a one-on-one coaching on www.streetwiseeconomics.com, and then we can talk more about that. I will see you on the next video, and make sure you comment and ask me any question that you want to ask on the comment section. Bye bye for now.